Hello traders and investors, welcome back to the Trend Trader channel. In today's video, I would like to share 5 fundamental truths about trading. These are the fundamental truths that I wish I knew before I started my trading journey, right? So these truths are taken from the book by Mark Douglas, Trading in the Zone. It's a great book. If you can get yourself a copy of it, I believe that book will significantly help to improve your trading game, right? So yeah, I started trading a couple of years ago. I tried to come up with a strategy that I wanted to use to trade the stock market. It worked for quite some time. The risk management was there, but what was missing was the psychology, like how to think as a trader, right? So after I read this book, then it became much easier for me to become a better trader. So it's just 5 fundamental truths. So the first one is that anything can happen. It is as simple as that. Anything can happen in the market. No matter how much you plan, you can plan something, but in the market, the market is always going to be full of surprises. For example, there are people that did their research, they did their homework, trying to make or finding relevant information about Steinhoff, and they did their job incredibly well. Unfortunately, at the end, what came out was that Steinhoff was cooking the result. So you see, you've done your work as a trader or as an investor, you are satisfied with the work that you have done, only to get punched in the face by something that you couldn't control. So learn that in the stock market, anything can happen, right? Then the second fundamental truth is that you don't need to know what is going to happen next in order for you to make money. You see, there is this obsession of wanting to know everything about everything. If you invest in the stock market, you are buying shares. Some people are so obsessed with research, doing your own research, trying to find as much information as possible before pulling the trigger. I'm not saying that there's something wrong with that, but knowing everything about everything is not going to give you an edge, because we do see people, they buy a company, the company starts to perform poorly, then they keep on convincing themselves that the fundamentals of the business haven't changed. Then they continue to hold on to the losing position. You see, too much information can lead some people to make decisions that are detrimental to their trading portfolio. So you don't need to know what is going to happen. Recently, we saw the Ukraine-Russian conflict. Well, it has been on the media for quite some time. We just didn't know when it was going to happen. Some people, they decided to stay on the sidelines because they wanted to see if the war was actually going to happen. Unfortunately, it did happen. And when it happened, gold or just mining stocks, they shot up. So the guys that were sitting on the sidelines, they missed on that opportunity. You see, well, I'm not saying that the guys that bought the gold and mining stocks, they knew what was going to happen, but just don't try to know everything about everything. Just if you see an opportunity, take the opportunity. Try not to over-rationalize over that opportunity, right? Then the third fundamental truth is that there's a random distribution between wins and losses for any given set of variables that defines an edge, right? What do you mean by this? We will speak about an edge briefly in the video where we're talking about when to sell your shares. So we spoke about an edge. We said that an edge is just a probability of, meaning that something is more likely to happen over the other. So once you have a trading strategy, you know your average wins and average losses, you know your win rate, then you can determine if your strategy has a positive expectancy. If it has a positive expectancy, then we say that your strategy has an edge. But just because your strategy has an edge doesn't mean that every time you take a trade, that trade is going to be profitable, right? You're going to take the trade according to the rules that you've set for yourself on how you are going to take trades in the market. Let's say, for example, your strategy is buying the dip. Not every dip that you are buying is going to work out. We've seen now we've got empirical data that shows that you can buy the dip and the dip can keep on dipping, right? Now, when we say that there's a random distributions between the wins and losses, we mean that every time you see a dip, you are going to buy a dip because you know that buying a dip is profitable for you. You just don't know which dip is going to work. So you can buy a dip in Apple, it works. You buy a dip in Target, it works. You buy a dip in Berkshire Hathaway, it doesn't work. You see, so the outcome is just random and there's nothing that you can do about it. So just keep on taking the trades as they come, as long as the trade meets your strategy or your criteria for stock selection. Just take that particular trade because you don't know the outcome of that particular trade until the trade is closed, right? And then the fourth fundamental truth is that an edge is nothing more than an indication of a higher probability of one thing happening over another. You see, so we always emphasize that you need to trade a strategy that has an edge. Once you have traded one strategy 10 times, then you've got a bit of information. You know your win rate, you know your average win, you know your average loss, and then you can do some calculations there to check if that approach has a positive expectancy, right? So once you see that the strategy has a positive expectancy, in this case, because we want to make money in the stock market, we are looking for a strategy that is more likely to be profitable compared to a strategy that is more likely to lead to losses, right? So now once we have a strategy that has an edge, so you know that over the long run, we are going to make money in the stock market. Since you don't know whether the trade is going to result in profit or loss, that does not matter anymore because you know that you are trading a strategy that has an edge. Every time you get a signal, you buy. Every time you get a signal, you buy. When the stop loss is hit, you exit. When the take profit is hit, you exit with money. But over the long run, you are just going to make money because you know that strategy works. So that is what we talk about when we talk about an edge, right? And then the last and fifth fundamental truth is that every moment in the market is unique. This is one of the things that beat most market participants, whether they are traders or they are investors. Let's say you are trading Apple shares. You buy Apple shares today, that trade becomes a loss for whatsoever reason why you chose Apple. You buy Apple shares, they end up in the loss, then you exit with the loss. Sometime along down the line, you get another buy signal for Apple. Now you are not sure whether you should buy Apple because the previous buy resulted in the loss. You see, now you are still emotionally attached to that trade that didn't work. What you need to know in the stock market is that every moment in the market is unique. The reason why that trade at that time didn't work, even if this trade does not work as well, it's going to be a completely different reason. That is why you need to accept that every moment is unique. I mean, we've been buying a couple of shares. Sometimes they work, sometimes they don't work from the same company. Like Steinhoff, we've been trading Steinhoff, getting in and out, in and out. You see, sometimes we make money, sometimes we lose money, but every time we get a signal of buying Steinhoff, we just go back in. We don't try to attach ourselves to the previous trades that we made there, right? So yeah, it is important that you understand that every moment in the market is unique. So if you can just wrap around these fundamental truths, I believe that they can help you to become a consistently profitable trader. I know that they have helped me. They have helped me a lot because now whenever I go to the market, I know that anything can happen. I don't have control over the market. The only thing that I can control is the amount of risk that I'm willing to take on that particular trade. I don't need to know what is going to happen next in order to make money. As long as I get a buy signal, I buy. If that trade works, great. If it doesn't work, who cares? I already knew that there was risk involved before placing that particular trade. I already know that there is a random distributions between wins and losses, but because the strategy has an edge, I know that over the long run, I'm going to make money. I know that there's a high probability that as long as I'm using this strategy that has a quantified edge, I'm going to make money. And I've accepted that every moment in the market is unique. So yeah, that's what I wanted to share with you today. Please in the comments share what has helped you to become a better market participant, whether you are a trader or an investor. And like I said, you can get this book, you can buy it on Amazon. You can also try to look it at your local bookshops. It did help me a lot, and I believe that it can help you as well. So if you enjoyed this content, please like this video and share it with as many people as you can. If you haven't subscribed, please consider subscribing to the YouTube channel. That will really help the YouTube channel to grow. Thank you. I will see you in the next video.